welcome to ForexTV.com's PM Exchange. It's Monday, February 11th. I'm Remy Hookey. Today I'm joined by Michael Woolfolk from the Bank of New York Mellon. Good afternoon, Michael.
Yes, good afternoon, Remy.
Great to have you on the show today.
Thank you for inviting me.
Well, as we start out the week, the U.S. dollar is under considerable pressure after seeing strong gains against the euro and sterling last week. But as we come back from the weekend, post-G7, we had ECB commentary from both Trichet as well as Weber saying that their focus is on inflation. So at this moment in time right now, would you say that the ECB is neutral in its policy? And what does this mean for euro-dollar?
I wouldn't say that the ECB is neutral on its policy just yet. Certainly, we've taken a very small step towards neutral. And I think that was evident in the last ECB press conference by Trichet. And if you read the statement very closely, that there was the wording changed ever so slightly, that they decided not to use the word preemptive in describing their future course of action with respect to data. If we're talking about a monetary policy bias, it seems pretty clear that despite the fact there are risks to the downside in terms of growth, the overriding concern, and certainly their mandate, is for the concern over risk to the upside with respect to inflation. And that's where I think that they'll err, is in trying to curb those upside risks by raising interest rates if there indeed is a change in policy between now and, let's say, mid-year. The G7 really didn't change much of that. There was certainly some risk going into the weekend, as there always is in front of a G7. And what you saw last week in terms of the dollar's rebound was what we believe to be nothing more than a technical correction. It was not the dollar putting in a bottom. It was not the dollar on the first leg of an extended dollar rally, but rather the market had become extraordinarily short dollars against euros. And after putting in a low, the dollar, following some dreadfully poor non-farm payrolls, and actually an ISM non-manufacturing survey, which reflects 70% of our economy, the service sector, which was the worst level we've seen since 9/11, then I think that the market had basically priced in about everything negative that we could possibly fear with respect to the economy. So growth rate differentials, interest rate differentials. I think where we are now is the market feeling comfortable with its positioning with respect to the U.S. dollar. I see that the euro probably, if anything, is going to be creeping up against the U.S. dollar to the upside as the market continues to price in expectations of a rate hike down the road. Sterling is something of a similar matter in that we had some data out today that suggested that inflation in the UK was becoming more of a concern and would limit the ability of the Bank of England to cut interest rates. So I think that is probably going to limit the downside to cable and perhaps curb, to some degree at least, the upside potential for the euro sterling.
Well, Michael, while we're taking a look at the global economy, we have key data coming out from the U.S. this week after a light week last week, and also in the Eurozone as well as in Japan and the U.K. we have data coming out that will be key focus for the FX market.
Yes.
So out of all the data coming out this week, which data releases do you think are key for Forex traders to be watching?
Well, certainly the U.S. consumer remains in a critical role with respect to growth looking forward. And I think that the surprise recently between December and January is some forward indications that maybe the U.S. consumer has temporarily suspended activity following the holiday shopping season. So advanced retail sales is going to be very critical, certainly in terms of this week's data. The U.S. trade data, however, is likely to surprise in the upside. Keep in mind that's still a fourth quarter report. It's a December report. It will factor into our U.S. GDP report for the fourth quarter. The second estimate will come in at the end of this month. And what many in the market believe to be an upward correction, an upward change in terms of the fourth quarter growth from 0.6 perhaps to something with a 1 handle. So expect a trade deficit there below 60 billion, perhaps. If anything below 55 billion, I think that we're looking at a large revision to the upside in terms of fourth quarter growth. But expect something in the area of 55 to 57 billion. I think that the third issue is the TICS report. We've had some remarkable volatility in terms of our capital flows report. It's important. It remains important, despite the fact that the data is considerably lagged. Keep in mind that November and December were months in which the dollar did show some strains, although were remarkably well behaved in terms of stability amidst the crisis. So what we're expecting to see there from TICS is a continued recovery from the outflows that we saw late last year, perhaps a TICS number in the area of about 70 billion, and we're going to be paying particular attention to what analysts call the total TICS figure. In other words, the long term plus the short term. The short term we thought was a good barometer of market sentiment, particularly access to liquidity. And during September and October, there was a notable absence of access to liquidity. So investors were selling liquid and good investments to fund bad investments in some respects. So expect that to be a nice number, maybe 70 billion in the headline number, maybe 110 in terms of the total TICS figure. So those will be really the three major reports. Industrial production, of course, comes in. We're not expecting anything particularly optimistic there. We feel that manufacturing is in recession in the United States. It may very well be in recession in parts of Europe as well. So you're going to see industrial production, perhaps Michigan confidence, both which are going to come in weak and perhaps surprise to the downside.
Michael, there's two events coming up this week that in the U.S. that's not on the economic calendar, but we have Bernanke's testimony on Thursday in front of the Senate Banking Committee. And also, if President Bush signs the fiscal stimulus package, this would potentially add to growth in upcoming quarters. But in today's session, as we saw stocks regain strength, we saw the dollar-yen bounce back. So if you could give us your near-term forecast for dollar-yen.
Well, dollar-yen, we expect to see the yen continue to benefit from risk aversion. And certainly we did see a little bit of strength in terms of U.S. equities today. The NASDAQ set in apparently its best performance since February 1st, which isn't much of a track record, but nonetheless does provide us a little bit of stability. Both the S&P 500 and the Dow were appearing to positioned to close on the upside. Overseas, Asia was quite weak. Europe was stable to slightly weak. And I think that as long as equities remain stable, that I wouldn't expect that the yen carry trades to come off any more severely than they already have. And so I think the 106 level is a comfortable level for dollar-yen. I see a range maybe from 105 to 110 over the next month. And that I'm a bit optimistic about the return of market stability and the rebound in global equity prices, particularly in Asia. And if indeed that happens, you'll see more carry trades and the yen coming under some pressure. So I think about 110 maybe another month. But for the time being, 106, 107. I think for the next trading session, 106 on the downside, 107.50 on the upside for dollar-yen. In terms of the two events that you mentioned, later this week you have Bernanke's testimony. I believe also Paulson's testifying, if I'm not mistaken. I tell you what, official commentary is always a good thing. I mean, it helps with transparency in the markets, and certainly market players need that constant feed of official commentary. I think Bernanke, again, has the mandate really to provide market guidance and also to, if when possible, put a positive spin on circumstances. And I really don't think that there's a convincing case that the U.S. economy is becoming unhinged, despite the fact we've had several very surprisingly negative numbers: non-farm payrolls, initial jobless claims, the ISM non-manufacturing, to name a few. But expect, I think, some positive comments from both Bernanke and, of course, Paulson will definitely be giving us the view that the glass is half full. Now, in terms of the White House, President Bush signing into legislation the fiscal stimulus package, there's only upside to that. I think it's a positive step in terms of making maximum effort to try to forestall this downturn and limit the damage it does to confidence. And confidence is always that undefinable, unpredictable factor. It plays havoc not only with Fed forecasts, but private street forecasts as well. I mean, we're really hoping that confidence is maintained, both in terms of the investor and the consumer. I think that certainly putting money in the pockets of the consumer this summer is going to be a positive temporarily. Whether or not it takes hold, it really is anyone's guess. And that's why there's, I think, a remarkable amount of disparity in terms of street forecasts about where we end up this year. If inflation matures the way the Fed expects it to, with slower growth limiting growth with inflation, I think that 2009 could be a very good year.
Okay, Michael, last but not least, before we wrap it up for today's interview, since we got your forecast for the dollar as well as the yen, let's shift over to the Asia-Pacific currency of the Aussie dollar. Overnight, we had a pretty hawkish RBA quarterly statement. Last week, this RBA raised by 25 basis points, which brings their benchmark interest rate to 7%. And as a result, we saw the Australian dollar gain to 90 against the U.S. currency, but we haven't seen the Aussie dollar rally back to highs above 94. So going forward, if you could give us your technical as well as fundamental forecast for the Australian currency.
Well, I think that the technical damage, as you'd pointed out, is evident. We have a bridge hold above the 90 cents barrier, and I think that particularly given the fact that the RBA has increased rates, data from the underlying economy suggests that growth and inflationary pressures will remain strong. We're seeing maybe the next trading session range of 90 cents to 91 cents, but the upside is probably going to be limited to maybe 92 and a half cents over this spring. I doubt that there's going to be enough momentum to carry us above 94 cents unless there is some significant change in terms of the U.S. dollar dynamics. Really, Aussie dollar's upside will be mostly to what degree the market loses confidence in the U.S. dollar and the Fed cuts interest rates. I think that conditions in Australia in terms of growth rate differentials, interest rate differentials, are about as favorable as they possibly can be. So some upside potential for the Aussie dollar, but until the market throws in the towel on the U.S. dollar, we would expect that to be limited to maybe 92 and a half cents.
Okay, Michael, as always, thank you very much for your insight and analysis into the Forex marketplace.
Thank you very much, Remy.
This has been your Forex News with Michael Woolfolk from the Bank of New York Mellon. Next up, we have your equities and commodities wrap-up for the day. U.S. stocks ended the first trading day of the week with gains. After starting out in negative territory, the major indexes paired earlier weakness in a mixed session. Wall Street weighed today's negative news as credit worries hit AIG International. In a regulatory filing, AIG said it would need to alter the way it values its credit default swaps involving collateralized debt obligations. Meanwhile, Dow Jones & Company said it was replacing Altria Group and Honeywell International with Bank of America and Chevron on the blue chip index. The change will take place on February 19th. At the closing bell, the Dow Jones Industrial Average advanced 57.88 to close at 12,240. The tech-heavy NASDAQ rose 15.21 to end at 2,320. And the S&P 500 gained nearly 8 points to close out the session at 1339.13. In the fixed income market, U.S. Treasury prices gained as renewed credit worries hit AIG International. Investors moved into safe haven assets over concerns about the outlook for the U.S. economy. The yield on the benchmark 10-year Treasury note gained with its yield down at 3.61% from 3.65% late Friday. The 30-year long bond rose with its yield down at 4.4% from 4.43% in the previous session. And the 2-year note was up with its yield at 1.92% from 1.95%. In energy, NYMEX crude oil futures gained for the third consecutive session. The benchmark crude oil contract ended with a gain of 2% on the day. Supply disruptions outweighed concerns about slowing global growth and weakening demand for oil. Over the weekend, Venezuelan President Chavez warned of ceasing oil exports to the U.S. Last week, ExxonMobil won a court ruling to halt a U.S. bank account holding over 200 million euros in PDVSA accounts. Exxon is now challenging Chavez's government and seeking compensation for the nationalization of oil fields it exploited in Venezuela. March crude hit an intraday high of $94.72 a barrel and closed out the session up $1.82 at $93.59 a barrel. In refined products, March heating oil futures gained 5.03 cents to close at $2.8044 a gallon. March RBOB gas added 3.9 cents to end at $2.3962 a gallon. Meanwhile, March nat gas futures gained 23 cents on the day to close at $8.531 per million BTU. Over in the metals complex, there were strong gains across the board. COMEX gold futures continued its upward climb, while platinum hit another record high. April gold rose $4.40 to end at $926.70 an ounce. And platinum futures soared, hitting an all-time high at $1,949 an ounce. The precious metal has been climbing to new highs as energy problems in South Africa continue to plague production. The April platinum contract gained $55.40 on the day to settle at $1,939.40 an ounce. In other metals, March silver added 36 cents to close at $17.47 an ounce. March copper added 1.9 cents to end at $3.5585 a pound. Now we're joined by James Mound from James Mound Trading Group and author of the Mound Report. He'll give us his commodities outlook for the week ahead.
This is James Mellon for MoundReport.com with the week ahead for February 11th. This week is all about the grain markets. We had over the weekend an expansion of the price limits in wheat to 60 cents, formerly 30 cents. A lot of times in markets like this, historically speaking, we have that as a major signal of a cycle reversal in the markets. That means that what we're getting out of the grain markets is a potential top. This is a market that's gone through extreme price rallies here, and the overall psychology of it is once you start expanding price limits, you also have to expand price margins, and people have to change their position sizing, and they have to change their stop placement, and it can trigger a major market reversal, which we actually have seen so far today. Market was lock limit up overnight, up 60 cents, and here we are closing the day down 34 cents and change. And it's a major signal for market reversal in wheat, and it should take the other grain categories down with it, like soybeans and corn. So look to develop bear positions in those markets over the coming weeks and months. In addition to that, last week we saw a major U.S. dollar rally begin to occur. A lot of that was due to the fact that even though the European Union, that is, did not make a rate change, we did see a rate change from the United Kingdom. And I believe a lot of people are turning a corner here and realizing that despite the fact that you could perceive what the Federal Reserve has done as an aggressive rate-cutting stance, the Europeans seem to be a bit behind the curve here. And that being a bit behind the curve is going to come back to cause a longer-term recessionary environment for European countries. That should be a big catalyst for the U.S. dollar in the next couple of months. Could also cause some pressure on gold and silver prices, even though we've seen a sustained rally in both of those markets right now. We're seeing huge price moves in markets like platinum and palladium, mainly due to the fact that we've had some South African mine shutdowns due to electrical blackouts. But overall, when you have a strong dollar, you have a weak metals market. But given the fact that the dollar's been weak for so long, the metals market's having a bit of a delayed reaction here. And this gives you a great entry point to establish put positions in gold and silver during these huge up days that are offering some discounted premium entry points. Last but not least, let's take a look at the coffee market. This is a market that's been holding a long-term trendline support, weekly, monthly chart, and overall very bullish long-term pattern is developing. But we haven't seen it just get up and go. And over the past couple of weeks, we've really seen this market take off from a major trendline support, break through previous contract highs that were set last year, and set off in a volatile upward trend. And this is mainly because of a short covering rally. There isn't tremendous news. We know that there might be some yield issues in Brazil. We know that there might be some weather problems in Vietnam and some quality issues there as well. But overall, this is just a market waiting to get funds and spec buying to push this thing over the edge. And so I'm a buyer on any dip in that market, and I expect to see a historic rally in coffee over the next 3 to 6 months. And that'll do it for me, James Mound, MoundReport.com in the week ahead.
That was James Mound from James Mound Trading Group with his commodities outlook for the week ahead. And that's it for today's edition of PM Exchange. I'm Remy Hookie. Join us tomorrow morning for your latest news update right here on ForexTV.com. Have a good night.